Hey traders, Jason here from Leavitt Brothers. How's it going? In this video, I'm going to do an update of my State of the Market series. The market has been strong. The indexes have been hitting new highs pretty much every week. Many high beta names have posted big gains. So let's dig in and see if the strength is supported. Before I start, quick reminder, my Masterclass is live. It's the class I wish I had when I started. It's the class I wish I had access to even after I was profitable, because it would have gotten me over the hump and accelerated my progress. Here are some comments from some students who have taken the class. One student said, I am making my way through the Masterclass, and so far I'm loving it. This is exactly what I was hoping for. Another student said, absolute legend. Thank you kindly for producing something so great and sharing it with us. Well, I don't know about the legend part, but thanks for the comment. You have truly changed the way I look at the markets. Hi, Jason, your masterclass was fantastic. I learned so much valuable information. Another student said, I just wanted to reach out and personally thank you for the course. I just finished it and wanted to let you know I definitely found some very actionable information. To be honest, I think your perspective is something I've not heard before. All right, so it's available at the link below. Check it out. All right, so let's get started here. I'm going to show the monthly, weekly, daily S&P 500 charts and then a handful of breadth indicators. All right, so let's get into it here. All right, here's the S&P 500 monthly. It's strong. It's trending up. Yes, you can argue that it's above its upper Bollinger Band, but if it retraces into the Bollinger Band, that signifies some sort of reversal. Maybe, maybe not. But there are a lot of instances where the market trends up along the upper band, like there and there, a little bit there too. So this could keep going. Okay, it doesn't have to, just because it's up against the upper band doesn't mean it has to reverse. My method of playing the market here is to not guess when the market's going to top. Just play it, play the best stocks in the direction of the trend and put stops in place. And when you get an opportunity to add to a position, add to it and push it a little bit, and don't guess when the trend is going to end. Okay, eventually it'll reverse. Eventually we'll get a legit 5 or 10% correction. I hope that happens sometime this year because it'll set up some good trades. But a lot of traders, they miss out on huge gains because they say the market can't go up much higher, and they sit on the sidelines or have very little exposure, and they miss out on big moves. Okay, so don't be that person. Okay, play the best stocks in the direction of the trend, and don't worry about trying to guess when it's going to end. All right, here's the weekly. Steady, steady, steady. I mean, that's how the market tends to operate. I mean, look at how steady this is. Look at how steady this is. Look how steady this is. A little bit there, and now we got another one of these steady moves above the 8 EMA. Okay, so a little bit away from the moving average. So maybe there's like a void space here. If the 8 gives way, then maybe we come down and test the 21. Okay, that's fine. But the trend is up. Our job is to play the market in the direction of the trend, put stops in place, push it when we have the chance. Don't guess. Okay, the trend is very obviously up, and there are no major warnings here. Okay, now let's look at the daily chart. S&P daily. Okay, move up, over, now moving up again. It's got a little bit of support here from the 8. If it loses that, I can see it filling this little void space here down to the 21. And if that doesn't hold, then perhaps a move down to the 50. Okay, but the trend is up. The market is strong. It's doing well. It's hitting new highs. You know, every couple of days it hits another new high. There's no reason to be anything but long with some stops in place. Okay, now let's look at breadth. Okay, first we're going to look at, this is the S&P 500 up top with the 10-day moving average of the NYSE AD line, the 50-day moving average of the AD line, and the 200-day moving average of the AD line. Okay, so with the 200, you can see the indicator's perched at a high level. It's been up there for a while. So long-term advancers are steadily beating decliners. There are no warnings here. Intermediate term, 50-day moving average of the same indicator, perched at a high level, no major warnings. Yes, there's a little bit of a divergence forming here, okay? But divergences at high levels are less potent than divergences at low levels. So yes, there's a divergence, but I prefer to just look at the fact that this is perched at a high level and isn't giving any type of major warning. So what this tells me is that it tells me the market has a cushion to work with. Even if we did get some near-term weakness, we have an area to play with. 10-day moving average of the AD line just recently hit a new high. High levels sometimes can be followed by little pullbacks, but high levels are an indication of strength, and strength tends to continue on. Okay, so there's no major warnings here. I don't see any divergences. I have no reason to believe that there's, weakness is seeping in. The market is in good shape. Anything can happen day to day. Anything can happen week to week. But what I see here tells me that if weakness were to play out, there's enough internal strength that the market will head back north afterwards. Here's the cumulative AD line at the NYSE. Okay, steady uptrend, running away a little bit from its 50-day moving average. Even if the market comes down here, it's got a cushion to work with. Okay, as long as this is steadily trending up, a little dip here and there is fine. It supports the uptrend. Okay, it's not really until you get a dip below the 50 and then it fails to recapture and then it heads south, like that tells you something's going on. But if you just get a move to the 50 or a move a little below the 50 and then it recaptures the 50, it's the trend is going to stay up. All right, so here's the Nasdaq versus the 10-day, 50-day, and 200-day moving averages of the Nasdaq advanced decline volume line. Okay, so the 80 line lets all stocks speak equally. It doesn't matter if you're Apple or a $1 billion company. With the volume line, the higher volume stocks, which tend to be the bigger companies, get to do more of the talking. So these prints here, this one here, this one here, and this one here, they're not just highs on this chart. These are like 20-year highs. Okay, so no matter what time frame you look at, long term with the 200, intermediate term with the 50, shorter term with the 10, strength on all time frames is as strong as it's been in more than 20 years. Okay, could the market do a little backing and filling? Sure, but there's enough underlying health that any type of weakness that plays out in the near term is probably going to get bought up. Cumulative of that of the 80 volume line, it looks like this. Big move up. Maybe it's getting a little bit extended here because it was like trending up here and then it kind of accelerated up here. Some sort of an inflection point over here at the beginning of November. Maybe this is not sustainable, but it does give us a good cushion to work with. If indeed the market were to pull back, it has room to pull back and do some backing and filling before it turns back up again. All right, next chart. This is the S&P 500 versus the NYSE new highs and Nasdaq new highs. You can see we got healthy levels here. NYSE new highs steadily printing. It's normal that you see, shoots up, shoots down, but generally speaking, they're at a high level. Okay, sometimes you run into trouble when there's a divergence, like we had one here and here as the market was heading up. Got that back here too. But overall, we have like really steady high prints, and this fully supports the market strength. So, if we had a situation where the market was moving up and new highs were like, down here, declining, sitting at a low level, then I'd start to wonder, how is the market making new highs when so few stocks are making new highs? But there's a lot of stocks making new highs. So this fully supports the trend. We dig in a little bit with new highs of large caps, mid cap new highs, small cap new highs. It's fairly normal that when the market dips, new highs will dip, but as long as they expand afterwards, the market's fine. So for example, new highs dipped here, but then they expanded. New highs dipped here and then expanded. That's normal. Okay, you don't really run into a problem until you get new highs dip like here, and then they don't expand. Okay, so as long as, recently we got a dip here at the end of January and then it expanded, so this is good. This is like, whether it's like large caps here, mid caps here, small caps here, we got new highs among all market caps are doing well, so this supports the strength. And here's new lows at the NYSE and Nasdaq. You can see new lows at the NYSE are actually 0 today as I record this, and at the Nasdaq right over here, it's actually 1. Okay, so there literally are no new lows out there. So if the market was, if the little bit of weakness was brewing, you can see here like a little bit of new lows expanding a little bit, new lows expanding a little bit as the market was moving up. But that's not happening here. So there are no warnings here at all. Now with new highs doing fairly well, and new lows being non-existent. The high-low at the NYSE is just oscillating up and down above zero. The high-low at the Nasdaq is oscillating above zero. This is exactly what you want to see. It is characteristic of a strong market. When the market is trending up, you get this indicator just simply moves up and down within a range above zero. Minor dips below zero, like here and here, are perfectly fine as long as they recover. It's dips below that can't then recapture the zero line that lead to problems. So far, we have no dips below zero, no warnings here. This is perfectly characteristic of an uptrend. All right, last chart. This is the S&P 500 up top versus the number of Russell 3000 stocks above their 20-day moving average. So when the market's doing well, you're going to get, the number of stocks above their 20-day moving average is going to expand and then kind of fall off, and then expand and then kind of fall off. Okay, that's fairly normal, and you don't really get a warning until a divergence forms. Okay, so for example, you had a little divergence here where the market went up, number of stocks above their 20 declined, and then we got this drop here. Market moved up, number of stocks above their 20 declined. Market moved up, number of stocks above their 20 declined. Okay. Market moved up, number of stocks above their 20 declined. Okay, so that tells you, you look underneath the hood, and if less and less stocks are participating, that kind of warns you that something's going on. Right now we have the market moving up, but we just got like a higher high print here. Okay, and this is high enough to reset the chart. So even if maybe this comes down and comes back up, and we get this comes down and there's a divergence, I don't know. I'm just saying, like, that's probably what's going to be needed. Okay, so as of right now, we can get a day to day, anything can happen, even week to week, anything can happen, but I don't see anything major developing that tells me that there's any type of problem brewing. Okay, right now it's a lot of stocks are more than 80. Just recently more than 80% of stocks were above their 20s, and that's good support. So I'd expect the market to continue to do well. Okay, so overall the market's in great shape. The indexes are trending up, and breadth supports the gains. Okay, anything goes day to day and week to week, but unless there's an external event, I'm betting the trend continues and the S&P rallies above 4,000. Thanks for watching. See you next time. Don't forget to check out my masterclass.